Hello, and welcome to my channel. In this video, we'll discuss financial statements and how to interpret them effectively. As a CMA student, it's critical to understand the basics of financial accounting and its purpose. Financial accounting is the process of preparing financial statements to provide financial information to external parties such as investors, creditors, customers, and government agencies. Financial accounting presents a true and fair view of the financial position, performance, and cash flow of an entity. This can be useful for external parties in making informed decisions about investing or doing business with the entity. To ensure that financial information is useful, financial statements should have certain qualities, including relevance, faithfulness, and comparability. Relevant information is material to the decision-making process, while faithful information represents the economic reality of the entity, and comparable information allows users to identify similarities and differences between entities. It's also important to note that financial statements should be prepared based on facts and assumptions. The facts are the actual financial transactions during the period being reported on. On the other hand, assumptions are made about the future based on past experiences and current expectations. To ensure consistency and comparability across different entities, financial statements should be prepared according to generally accepted accounting principles, GAAP, which is a set of guidelines that dictate how financial statements should be prepared. Moreover, it's essential to note that financial statements complement each other and are necessary to provide information for economic decisions. Another critical assumption in preparing financial statements is the going concern assumption. This means that the entity is assumed to continue operating indefinitely unless there is evidence to the contrary. The going concern assumption enables the entity to use the accrual basis of accounting. This is where revenues and expenses are recognized when earned or incurred, regardless of when the actual cash is received or paid. Financial statements consist of several components. These components include the statement of financial position, income statement, statement of comprehensive income, statement of changes in equity, and statement of cash flows. Additionally, notes are provided to explain financial statement information in more detail. The notes typically include relevant details that help users of financial statements understand the accounting policies, methods, and estimates used in preparing financial statements. The statement of financial position, also known as the balance sheet, shows the company's assets, liabilities, and equity at a specific point in time. The income statement shows the entity's revenues and expenses over a specific period, resulting in the net income or loss for that period. The statement of comprehensive income includes all equity changes during the period, including those not included in the income statement. The statement of changes in equity shows how the various components of equity, such as retained earnings and capital contributions, have changed over the period. The statement of cash flows provides information on how the entity generated and used cash during the period. Users of financial statements can be both internal, such as management and employees, and external, such as investors and creditors. These users rely on financial statements to make informed decisions regarding their investments or business with the entity. The elements on a statement of financial position are assets, liabilities, and equity. Assets are the resources controlled by the entity that represent probable future economic benefits. Liabilities are present obligations arising from past events that are expected to result in an outflow of economic benefits from the entity. Equity is the residual interest in the entity's assets after subtracting all its liabilities. These elements are considered permanent accounts because they represent the long-term financial position of the entity. The statement of financial position provides valuable information about a company's financial health. However, it also has some limitations that should be taken into account. One limitation is that some assets are recorded at their historical cost and may not reflect their current market value. Additionally, the statement of financial position is a snapshot in time and does not capture changes that occur shortly before or after the reporting date. Another limitation is that preparing the statement of financial position often requires estimates and management judgment, which may introduce subjectivity into the process. Finally, some valuable items that cannot be objectively recorded, such as employee skills and brand reputation, are omitted from the statement of financial position, which may lead to an incomplete picture of the company's financial position. Income statements are financial reports that show an entity's economic performance over a specific period of time. It is calculated by subtracting expenses and losses from revenues and gains. On the other hand, the statement of comprehensive income is a financial report that includes items not reported in the income statement. These items include gains or losses on hedging instruments, unrealized holding gains and losses. Income statement elements, including revenues, gains, expenses, and losses, are considered temporary accounts. Revenue is the money produced by carrying out normal business operations, while gains recognized when the market value of an asset exceeds its purchase price. Expenses, on the other hand, are decreases in economic benefits in the form of outflows or depletions of assets or incurrences of liabilities that result in decreases in equity. There are two types of income statements, one-step and multi-step, with the latter being the most common. Irregular items should be reported separately, such as discontinued operations, extraordinary items, and changes in accounting principles or estimates. However, income statements have limitations. For example, net income may not include all income and expense items because some are reported on the comprehensive income statement. Additionally, accrual-based financial statements may not be sufficient to assess liquidity, and management may need to make estimates and judgments. These estimates and judgments may be subjective and can affect the reported financial results in the income statement. Moving on to our next topic, which is change in equity statement. The statement of changes in equity is a financial statement that shows how the owner's equity in a business has changed during a certain period of time. This statement is important because it helps investors and other stakeholders understand how the company's equity has changed over time, which can indicate how the company is performing financially. Common components of this statement are share capital, common stock, change in other comprehensive income, and retained earnings. However, it's important to note that this statement has some limitations also. For example, it only reflects data based on the accrual accounting method. It only covers a specific time period, so it doesn't give a complete picture of the company's financial performance over a longer period of time. The cash flow statement is a financial statement that presents information about a company's cash inflows and outflows during a specified period of time. This helps assess an entity's ability to generate future net cash flows, meet obligations, and maintain financial flexibility. The structure of the cash flow statement consists of three main sections: operating activities, investing activities, and financing activities. The operating activities section presents cash inflows and outflows directly related to the company's primary business operations. The cash inflows from operating activities may include customer receipts and interest income, while outflows may consist of payments to suppliers, employees, and income tax. Investing activities shows the cash inflows and outflows related to the company's investment activities. Cash inflows from investing activities may include proceeds from the sale of long-term assets or investments, while cash outflows may include the purchase of property, plant, and equipment, and the acquisition of intangible assets. Financing activities show cash inflows and outflows related to company financing activities. Cash inflows from financing activities may include proceeds from debt or equity securities issuance, while cash outflows may result from debt repayment or dividends to shareholders. There are two methods of calculating cash flow: the direct method and the indirect method. The direct cash flow method involves the direct calculation of cash inflows and outflows from each of the three sections. The indirect cash flow method starts with the net income figure from the income statement and then adjusts it for non-cash items and changes in working capital accounts to arrive at the net cash flow from operating activities. Despite the usefulness of the cash flow statement, there are some limitations to its use. As non-cash items are not included in cash flow calculations from operating activities, which means that changes in the value of non-cash assets, such as depreciation or amortization, are not reflected in the cash flow statement. Another limitation is that the statement may not represent the true liquid position of an entity, as it only reflects cash flows, not the availability of cash or cash equivalents. Finally, the information presented in the statement can be manipulated, as management may increase or decrease the net cash flows reported on the statement of cash flows by manipulating the timing of cash transactions. Thank you for watching. If you have questions or suggestions for future videos, please leave them in the comments below. Don't forget to like and subscribe.